Hey guys, welcome to this video. Will Sebastian here, full-time multi-asset day trader. Remember, you can get my free training underneath. Don't forget to like, share, follow, subscribe, and comment, and all the rest of it. So what we got here? Well, I did a video on the dollar CAD today. I'm now going to do a nice breakdown on the New Zealand dollar against the US dollar. So of course, as always, let's just flick it up to the 12 monthly. The data on TradingView you can see goes back to 1971, at which point you had several years of up move. And then on that peak, you came way, way, way down. So it was like this, okay, big fall there as the dollar loses value in the 17s, big fall again as it starts to lose value through the 80s. And since then, you're more or less where you were. You haven't had too much of a change. So fairly predictable market over the years, only really ranging from the low there to the high here, okay? And that's since 1985 or however long, 1984. So that is, of course, 125%, as you can see. The majority of that range has stuck between more or less 0.53 to 0.85, okay? So 60-70%. Now, if I just take to the monthly, because we don't really need to look at the yearly too much at this point, you can see that we've come down also for a significant period of time. And if you draw your trend line taking you from up here all the way down, you can see the overall market trajectory has been thin, okay, straight down to the downside, and it's trickled and trickled and trickled. And what you've got at the moment is a continuing trickling market. Okay, so what I mean by that simply rather is, of course, that you're just coming down and down and down and down. The market isn't really showing any real long side bias like it did down here. Now, for that reason, and looking at the candle that's forming here, which is fairly full-bodied and heavy to the downside, it wouldn't really shock me if you break this low. But what is significant about the New Zealand dollar against the US dollar is this point here, okay, and this point there. Those are areas of long-term price rejection, or in other words, these are areas where traders have pulled out shorts and got long. Largely, I would probably say institutional traders, professional traders alike, but the mass capital in the market is looking for areas like this, okay? When you had it long down here, it fell slightly lower. You went to 0.52 rather than around 0.55 area, coming on to 0.55. So that low was lower than this one, okay? But you have bounced here and bounced there before. So what I would really start to look for is the following. If you do return to this level, it constitutes a long entry. Now, the only thing I would say with this is that because your pop-up only came thus far, and of course, if you drew a trend line from there, probably more applicable to your weekly or daily charts, you can see it's very, very steep. And that's because, like I said, you don't have that long side impetus, and you can't see that big long side impetus at the moment at all. So because it's only come up this far, and you don't have a very far retracement, it then tries again, and it's really, really looking weaker and weaker and weaker, okay? If there was big strength there, you would have had something like this, and it just keep going up. But that hasn't happened, okay? Each bounce is getting worse. As you can see, you bounce from here, and then you come down here, and then your bounce only goes that far, and you're straight back down, okay? The market is pulling straight back down. The negative sentiment, in this case, is with the New Zealand dollar, because the dollar is dragging it down and gaining value. So I wouldn't be shocked if we get down here. And if we do get down here, I would consider your size very carefully. Given what I just said about the fact it's only come thus far and it's dripping very heavily straight back into this area, I would probably deviate your size slightly to what you would have taken at this point, okay? Obviously, this was the first time you'd come back here or even created the level, and then you've come back, and that's time number 2. Now you're on number 3, and 3 has actually come within a year of the last one, okay? So long it slightly tentatively. Now coming under that, you really need to look at more or less where you would like to get long again if you're DCA entering. Now, whenever I teach people, you'll notice I talk about consistency. The best way to get consistency is to, well, especially if you're swing trading or investing, is to basically look for the most applicable price after these levels. Of course, you can see that just about here where you come under there, because this point where I've just labeled over here is what allowed this to happen. And the last time you came to this level, markets flew up from here as well. Okay, it's worth noting, and all round here. So clearly, this is a very much preferred level for investors alike. So if you took a long 0.56 and then you thought, okay, well, I'm going to hold off a long way because I know this could go much further on the very long term. Bear in mind, this is a long-term way of trading for consistency, like I said, because the mass population of whom are watching this is probably going to be looking for that. That's why I would hold off there. And of course, you can put in any DCA hedging methods like I use personally to mitigate any growing loss and control your equity at all times. But that would be my predetermined level 1 and predetermined level 2, because those are the areas where you can clearly see price has had previous rejection. And if it's had previous rejection, normally it's an area where one would like to take it long. So entry 1, DCA 2 is below. Now, in regards to the short side, you would really need to come quite quickly back up at this point. And more or less it would come around here. And it's just because, again, instead of getting long, you're looking for resistance, you're looking for upside reasons to have a bias for shorts. In other words, resistance. And you can see throughout history on your higher time frames, which, by the way, rule markets, okay? Higher time frames are essentially your master time frame. On higher time frames, you can see various levels of resistance. And of course, that would coincide with the downtrend that you've experienced like this. Okay, consistent lower lows and lower highs. If you were to draw a parallel line, okay, you would need it something like that. Okay, because this isn't a lower low here, then this one, that's how it would be drawn. But I'd let computers do all of that for me. It makes things a lot easier. So you can see, like I said, your DCA may come much further down. Okay, so just going back to the short side, that would be short entry 1. And then I would consider perhaps your next entry, like I said, comes at further levels of resistance, which exist higher up. That would be around there. So what you're doing is, instead of getting long, like we just discussed, you're planning for the short side market as well, because don't forget, if you're trading a downtrending market, you do also have the opportunity to buy within that downtrend as well. Okay, it is easier in some ways to short only on the other side, but you have to remember, if you're buying in the downtrend, you're also trading a new uptrend on lower time frames. Okay, so you have to decide what your style is. Are you a long-term investor / swing trader who's holding off significant periods of time with larger entries? Or perhaps if it does come about that a new uptrend is forming on lower time frames, 5, 15, 1 hour, 4 hour daily, you might consider changing to fit that bias, to fit that new arrangement of the market. Of course, your stock oscillator and MAs will give you an idea of value. This level 1 probably will coincide with your 40 MA. Level 2, perhaps your 100 MA, will trickle along nicely as well. Stock oscillator down or stock oscillator up. At the moment, you're very much in the middle. Okay, so you've got median value, but I think just given the way the New Zealand dollar and US dollar, much like the AUD dollar against US dollar, is shaping up, wouldn't entirely shock me if you do find that it continues to trickle down and down and down. And it's really important to be aware of that, because it allows you to space those positions out. It allows you to drop your size with the knowledge that because of what you can see traders doing already, you can see heavy short side bias. You might consider just spacing out your entries, being a little bit more careful, so that, of course, you can control your risk, because risk controlling, risk management is what everything is about. If you can reduce that risk inherently as much as possible, you'll find things get way, way easier to manage. So, as always, thanks for watching. I'm Will Sebastian. Get my free training underneath, And of course, as always, I'll see you in the next one. If you've got a question, ask it below. See you there.